Well, I know it's been a while since I uploaded a previous video. In today's video, I want to, take the time and talk about the markets with a focus on the election that occurred on November 5th in America with Donald Trump's victory. So first things first, I'm going to just start off with Bitcoin. I've got the election date, November 5th, marked out here. As you can see, Bitcoin essentially found a breaking point to this 8-month consolidation on the election date, broke the highs, and then ran for a few weeks up to roughly 100,000. Now, I don't think that's a coincidence that this happened. There were some unfavorable aspects of a Kamala Harris administration on crypto. But I think what the market is really pricing in is the possibility of the USA creating a Bitcoin strategic reserve. Now, if you don't know what a Bitcoin strategic reserve is, it's a proposal by the U.S. Senate, the Republican Senate, to essentially take the 200,000 Bitcoin that they already own, put it in reserve, restrict its selling for anything but paying off the debt, and then create a plan to acquire up to 1 million Bitcoin in total, at some point in the future. And all of that Bitcoin would be restricted, its sale would be restricted only to pay off U.S. national debt. So, that gets very interesting. I won't go down that rabbit hole fully, but, I'm a huge proponent of that. I think if the U.S. successfully pulls it off, they could get into a situation where, they can deleverage their balance sheet and actually pay off some of the national debt. So it's very interesting. If it's successfully implemented, it will definitely have implications on the U.S. bond market. But anyway, so at this point, Bitcoin, it ran for 3 weeks. It found a, not really a top, but a local high around 100,000. Came back, tested this support right here, bounced off the support. It's unclear at this point if you just get a continuation and blast through 100,000, or if you get, something of a consolidation here, create some type of pennant formation, and then break later on towards the end of the year. Both scenarios are possibilities. I'm not super set on either continuation or consolidation, but I really don't see a crash on Bitcoin going into the end of the year. I know a lot of people are already calling the top, but if you just look at this from a time perspective, Bitcoin has consolidated for 8 months, and then it broke it for 3 weeks, and you have one daily down candle. If you are of the bear's predisposition, it doesn't look good for you here. You kind of, this is an unprecedented consolidation for Bitcoin. If you go back in history and try to find a time where Bitcoin consolidated around the same price point for 8 months, it's very difficult to do, even in a bear market. So the idea is that when the consolidation finally breaks, that you're not going to get, it's not going to peter out very quickly, because the expansion of an expression of volatility will match its duration to the amount of time within the consolidation. So long way of saying that, this rally probably has legs. Now, with that said, things can cool off for a little bit, but on the broad picture, if you're looking at the monthly, you have 8 months here. Honestly, my base case is you have eight month consolidation, then you get an 8-month rally. So I know that's not that's not going to align with people who are a little bit more bearishly predisposed. Full disclosure, I am a mega bull, so there's no complications there on my end. I really, my cycle targets are probably way beyond most people's. If you apply the multiple from 2017, like how high Bitcoin went in 2017 beyond its previous all-time high to the current bull cycle, you get an ultimate price of beyond 1 million, which, of course seems outlandish to people. And, a lot of people think that it can't happen because they believe in what's called diminishing return theory for the cycles, which is that, in 2017 you got less of a pump than you did in 2013, and then in 2020 you got less of a pump than you did in 2021 you got less of a pump than you did in 2017, and therefore, in this cycle in 2024, you'll get less of a pump than you did in the prior cycle. Now, I don't subscribe to that. I think it's correlation without causation. And I wish I had the Bitcoin supply curve chart, but you can see, if you look at the Bitcoin supply curve, you can see a very clear S curve where the supply schedule starts to level out around these couple of epochs, but then it hits a higher, steeper gradient as you get towards some of the later epochs, or what people colloquially refer to as hyper-Bitcoinization. I think we're kind of dipping our toes into hyper-Bitcoinization at this point because, because of the Bitcoin ETF, and you're getting this amalgamation of Bitcoin into like the financial service sector on like a very real high level. So that's something that's never happened before. And it's like injecting a Trojan horse into the system, right? People in the financial services industry can't not pay attention to it. A good example of that is, if you take Bitcoin in a portfolio over a 4-year period and you allocate 1% of that portfolio to Bitcoin and 99% to cash, that 1% Bitcoin portfolio and 99% cash portfolio tends to outperform a 100% equity portfolio, say invested in the S&P 500, over most 4-year periods you can record. So I encourage people to go back and back test that, the claim I just made, because it's really eye-opening. But the point is that the asymmetric risk profile of Bitcoin is superior to every other asset, right? So these institutions, they don't need to, go 100% Bitcoin right away, but they do need to embrace a position in Bitcoin, a small position, and they still get that asymmetric reward from embracing a small position. And they're just dipping their toes in right now. But of course, what happens is once these institutions start holding a little bit of Bitcoin, they get orange pilled and their conviction starts to grow. They start to learn more, and then they gradually increase their allocation. Now that won't happen in one cycle, right? There's like 100 cycles left. But that's what's starting to happen now. And I think this cycle is very important. Although I don't think it's the final cycle, as some people have indicated. Now, I also want to talk about the impact that the Trump victory has had on the currency markets and the bond markets as well. So if you look at well, the dollar, we're looking at the dollar currency index right now, and the dollar bottomed before the election, but started to really run after Trump won in early November, as you can see right here. Broke up to these new highs, took liquidity out, and now it's started to roll over a little bit. So, the Fed is cutting. Right now, they're cutting interest rates. So theoretically, the dollar should go down as the Fed cuts rates. But what's important to understand is that, when you're looking at the dollar currency index, it's not just is the Fed cutting for, should the dollar go down, but it's relative to other currencies, right? Is the Fed cutting more than the Central Bank of Europe, right? If the answer is yes, then the dollar will decline relative to the euro. If the answer is no, then the dollar will continue to appreciate. So, when you're looking at the dollar currency index, it's mainly a comparison of the dollar to the euro and the Japanese yen. So just something to keep in mind there. I think the implications of a Trump victory are pretty significant in the sense that Trump wants to reestablish American industrialism, which means reshore American industrialism, and that can't be done with a high dollar, right? You can't do that. In order to reindustrialize America, the American government would need to bring the dollar lower. Now, I won't go into all the reasons why, but I encourage you to do your own research on that. But it's laying out an incentive for how the government would be incentivized to bring the dollar lower to fulfill their political goals. And also, when you have tariffs between countries, that could have an impact as well. Now, just looking at the technical side of the dollar, what this looks like is very similar to Bitcoin in 2017. So I'll just pull up the Bitcoin chart here. So I go to Bitcoin in 2017. You have this parabolic run up, blow off, and then you get a whipsaw in volatility right here, and then volatility dies off, and you get this like dead heartbeat pattern. This is very, very, very signature and a very important characteristic to understand in the markets. Parabola. And the reason why it's so important is because, the only constant in the markets is human psychology, right? So I as an individual, I can't predict when a billionaire will call his broker and say buy, X amount of this or sell X amount of that. I can't predict that. But what I can do is I can predict how the masses will respond in their psychology. And the reason why parabolas are interesting is because they have the most dramatic impact on people's psychology. This is very important to understand. So, and this is a classic parabolic blow-off right here. So you got your 2017 blow-off in Bitcoin, volatility whipsaw. Volatility is really, really high during these months here, right? Option premiums are probably skyrocketing. And then the volatility whips around, Bitcoin crashes, and then you get a volatility crush, right? And then it consolidates around the low. Volatility gets absurdly low from this parabolic point, and then you get one final capitulation, which if I had the volume marked off would be marked by a very high volume. So you get volatility expansion, compression, low volume, and then high volume capitulation. Very important signature to understand. Now, if I go back to the dollar index, that's kind of why I've got these markers marked off here, because I'm seeing a similar, structure in the dollar currency. So you got this parabola here. The dollar goes parabolic in 2022, blows off, and then you volatility is expanding here. You get a whipsaw in volatility, and then you get a volatility compression. Now, I understand it's not the same exact heartbeat pattern as you had on Bitcoin, dead heartbeat pattern following the blow off, but you are seeing somewhat of a compression of volatility relative to this period here. And, that kind of lends itself to the idea that, again, if, you could see the dollar come back and test these lows and then, kind of consolidate around that region. But similar to in Bitcoin, how you had a parabolic blow off and then a support found and consolidation around that support, if you get a break of that support on the dollar at some point in the future, you probably get that capitulation, similar to Bitcoin in 2018. And then, if that were to occur, then, during that period, if you're on Twitter, financial Twitter, you say the dollar went to like 95, right? Or 90 in a capitulation event. You would be hearing a lot of people saying then that like the dollar's, done, or it's the end of the dollar, things like that. And that would really actually be the best time to go long dollars, right? Because, currency markets are mean reverting markets, right? They operate relative to each other, not based in any physical reality, and the central banks there are there to suppress volatility, right? So when you get a volatility expansion, you almost know with certainty that the central bank will step in and put a lid on that volatility, at least try to put a lid on that volatility, otherwise referred to as the Fed put. All right, so now let's move over to interest rates. So I'll pull up the 20-year yield, which is what's underneath the biggest bond portfolio in America, TLT with BlackRock. It's based on the 20-year yield. I like talking about the 20-year yield because the long end of the curve is less manipulated than the short end of the curve, closer to the Fed funds rate. So the Fed funds rate is 4.56. The 20-year yield is 4.51. You can see the yield curve down here. TradingView so graciously puts it down here. But basically the long end of the curve has risen towards the Fed funds rate. So you've got an inversion of the yield curve, or uninversion of the yield curve, right? The yield curve was inverted. The Fed funds rate was way higher than the 20-year, and now the Fed funds rate has fallen while the 20-year has rallied. And if we go back to that Dixie chart, right? People are like, well, did the Dixie rally because of Trump? Well, no, the dollar rallied before Trump, right? The election was here. The dollar found a low on September 30th. Now, if we go back to the 20-year, bear with me here. So if you go back to the 20-year, the interest rates started rising, or yields started rising in September, and that's when the dollar found a low and started rising. So essentially, the dollar chases yields, basically. And I think people can get distracted with, what the federal government, this is just a short-term move. You can build a narrative about what the Trump campaign election means over, a long-term period. But for short-term moves like this, there really isn't a reason why yields rallied for a couple weeks. But there is a very strong causation between the dollar rallying and yields rallying. So if yields rally, the dollar is going to rally further, okay? And if yields fall, the dollar is probably going to fall further. Just an important base case to understand. Now, as far as where yields go from here and what long-term implications the Trump presidency has on yields, I think it's important to understand that essentially, the Trump presidency was very bullish on energy and very pro-energy policies, which will push down the price of oil and push down the price of energy more broadly relative to a Democratic victory. And if you push down the price of oil and the price of energy, oil and energy are used in the production of every good and service, basically. So when you have low energy costs, you have lower costs of goods and services. So you could expect inflation to go down. Now, the Democrats did not win the House or Senate, and that would have been the most have the most significant effect on yields, because if you have a Republican victory in the presidency or the White House, and then a Democratic victory in the legislature, well, then you end up with a gridlock where there's not a lot of spending, and that's if you're not having a lot of spending, then you reduce the deficit, and that makes bond investors happy, right? So that would have been the most bullish scenario for bonds if the Democrats had won the legislature and Trump won the presidency. But that didn't happen. The Republicans won the White House, the Senate, and the House. So it's a Republican sweep, and that has the implication of increased spending, right? Because the Republicans, they may say that they want to cut spending, but at the end of the day, they've got full access to the purse of the U.S. government, and there's no Democrats to stop them from spending. And there's no political downside to spending. So they're going to spend a lot. They're probably not going to solve the deficit. The deficit problem is probably going to get worse on a structural level. If you were to go to the U.S. debt clock and look at the outstanding debt, or forecasts of the debt to be issued in the next year, relative to the amount of tax receipts collected, the government, again, I don't have the numbers in front of me, but the government's basically spending 5 times what they collect in taxes. It's crazy, and I don't think that's going to stop anytime soon. So you basically have a very pro-energy policy, which is good for yields, but you probably have increased spending as well. I don't know if increased spending is the right word, but sustained spending and sustained debt structure issues. So you've got these two contrary effects on yields. Kind of a mixed bag. But another reason why investors might want to purchase bonds is if they're fearing a recession. And I think largely those fears have gone away. Now, you could make an argument that, they still exist in the system, but I think, you kind of have to put yourself in the shoes of investors. And I think pro-energy, low tax policy of the Republicans, lowered interest rate policy, low taxes, low energy costs, regardless of what your political beliefs are, that's the type of thing where investors would see that and, kind of write off the recessionary case, and therefore, reduce their demand for bonds. Because again, in a recession, if you have a true recession, bonds tend to be the best performing asset in that environment. But let's move on to SPY. So this is the S&P 500. What I've got marked off here is the prior bank bailout program. So, a lot of people, I was on Twitter following this in real time, and I was very surprised to see that people didn't catch this. But if you were around during March of 2023, you know what the words BTFP means, the Bank Term Funding Program. This is the weekend where Silicon Valley Bank blew up, and the Fed unveiled the Bank Term Funding Program to take all of these bonds that had been massively devalued by rising interest rates and offered to issue them credit and treat that collateral as though it was at par, which means pretend like the bonds hadn't lost any value, right? Well, how does the Fed pretend that the bonds hasn't lost any value? They print money to cover the difference, right? So, the banks that were going to the Fed for that credit, they would have never been able to pledge that collateral to anybody else for loans, right? It was a bank bailout, but shrouded in mystery, not mystery, but made potentially confusing to laymen is the best way to put it. So, like whenever there's another bailout, you can almost be guaranteed that they'll say it's not QE. It's just a simple program that injects, hundreds of billions of dollars into the financial system. They're very subtle and sneaky about the way that they print money and inject liquidity into the system. It's watch one hand while they're doing it with the other. But anyway, the point is that the bailout program occurred right here, and the market has gone up 50% since that point. Trying to get a price range here. Yeah, if you see I put a price range up, it's over 50%, it's 58%, and about 30% per year. So these are crazy returns, right? And, I still don't think a lot of people caught on to what was happening here. You had this huge run up here, past the all-time highs in SPY, but then once we got a little bit above the all-time highs, then you get these shakeouts here that kind of shake people out, and everybody's seeing a top here, a top here, a top here. Meanwhile, the market, what's really happening is the market's just screaming higher. And I think, again, going back to what I was talking about with parabolic advances is, you really want to, or I want to look at this as a parabolic advance, like we talked about with Bitcoin and the DXY, which means, again, I don't know when this will top off, but what I do know is this is accelerating, right? It's the rally is steepening, and my base case is that it's steepening into a blow-off top, right? And I don't know when that will happen. Theoretically, it could happen now. At this point, we've already gone parabolic. I don't think it's likely to do that now. I think it's actually likely to steepen further. But using the same principles we did when I looked at the Bitcoin chart that went parabolic and the DXY can apply here. You're seeing an expansion of volatility, but volatility as the parabolic advances, keeps getting greater and greater, and it starts to get excessive, right? Because you get this whipsaw action, right? So this is actually not an expression of high volatility here. When you have bull markets, they can rise sharply, but they actually do it on low volatility. And of course, when I say that, it's relative to bear markets. But if you were to look at option premiums during this period, it would be much, much higher than option premiums during this period. So if we assume the base case that the parabola is advancing, then you actually do start to see volatility grow, and you see steeper price action and more whipsaw behavior until the parabolic blows off. And that's difficult to really get a sense for like when that would be, but I think it's fair to say if you see a 50% drawdown in the S&P 500, that's a blow off. Okay. Now, of course, it can blow off less than that, but let's just go back to what happened in 2000 during the dot-com bubble. Let's see this. So you got your top right here, and okay, you got a 28% collapse. Again, I'm probably thinking in Bitcoin terms. You really don't need to see a 50% collapse to see a blow off, but let's see if we put a 28%. Yeah, I mean, that's pretty significant. Again, I don't think we're going to blow off here. I think the market will rally further. Maybe it rallies up to this level and then comes back down. Here, blows off. Again, when you have these like parabolic markets, there's no honor in calling a top, right? There's no glory in calling a top, right? If you go back and look at all the people who call tops here, call tops here, call tops here, call tops there, right? It leaves a lot of bodies along the way of top callers. So everybody's plan for how they deal with that, or if you do have a big position, say you got lucky and you got a position in the S&P 500 down here, and the market's gone in your favor, and you're like, okay, what do I do now? Like, where do I take profit? Well, I would argue that you would want to take profit, you'd want to distribute and not take profit at one particular point in the market, but to sell over time, right? And I think that's really important because when you have these parabolas, there's a lot of less certainty over what will happen to the price, right? Price can go crazy and go to levels that people don't expect, but the time component of it is pretty steady and orderly, right? You know that like if you just sell into this parabola, say you distribute a small amount here, and then if it goes further, you still distribute a small amount, but slightly more than your prior small amount. If you just do that consistently, you won't sell the top exactly, but you'll be in a position where when the blow off ultimately occurs, and it will, all parabolas blow off, that you'll have at least taken profits at a favorable time if you have a plan for distribution like that. Anyway, I hope you guys like this video. I know I haven't been uploading as much as I should. I've been quite busy with work, but my plan is to increase my upload frequency and get some of this info out to you on a more regular basis. So thanks guys, and I'll catch you in the next one.